Welcome to our channel, A Person Life Cycle. Gold prices are reaching extraordinary levels, driven by economic uncertainty, central bank buying, inflation concerns, interest rate expectations, geopolitical tensions, and strong investor demand. But why is gold so valuable? And can the rally continue? Discover the forces behind gold's rise and what it could mean for the global economy and investors. Chapter 1. Why is gold so valuable? Gold has been valuable for thousands of years. Today, it is once again attracting enormous attention as its price has reached extraordinary levels. But why? The answer is not just inflation or investment demand. Gold is rising because several forces are happening at the same time. Economic uncertainty, central bank purchases, interest rate expectations, geopolitical tensions, and concerns about currencies. Gold is often called a safe haven asset. When people become uncertain about the future, they often look for something they believe can preserve wealth. And gold has a long history of doing exactly that. Chapter 2. Investors want safety. One of the biggest reasons gold rises is simple. People buy gold when they are worried. When stock markets become uncertain, wars create fear, or economies appear unstable, investors often move part of their money into assets considered safer. Gold does not depend on the profits of a company. It is not issued by a government, and it cannot simply be created by printing more of it. This gives gold a special psychological value. When uncertainty increases, demand for gold can increase too. And when millions of investors want the same limited asset, its price can rise quickly. Chapter 3. Central banks are buying. Central banks are one of the most important forces behind the modern gold market. Countries around the world hold gold as part of their reserves. In recent years, many central banks have increased their gold holdings. Why? Gold gives them diversification. Instead of holding all their reserves in foreign currencies or government bonds, they can hold part of their wealth in physical gold. Gold also carries no direct credit risk from another country's government. This makes it attractive during periods of geopolitical and financial uncertainty. When central banks buy large amounts of gold, they create strong long-term demand. Chapter 4. Interest rates and the Federal Reserve. Interest rates have a major influence on gold prices. Gold does not pay interest. So when interest rates are high, investors may prefer assets such as bonds that provide income. But when investors expect interest rates to fall, gold can become more attractive. Lower interest rates can also reduce the opportunity cost of holding gold. This is why investors closely watch the U.S. Federal Reserve. Every decision about interest rates can influence expectations about gold. If markets believe rates will fall, gold may receive additional support. Chapter 5. The dollar and inflation. Gold is generally priced in U.S. dollars. Therefore, movements in the dollar can affect gold prices. When the dollar weakens, gold can become more attractive to international buyers. Inflation is another important factor. When people worry that their money will lose purchasing power, they may look for assets that can preserve wealth over time. Gold has traditionally been viewed as a hedge against inflation. However, gold does not automatically rise every time inflation increases. Interest rates, currency movements, investor sentiment, and economic conditions all matter. Chapter 6. War, Politics, and Uncertainty. Geopolitical tensions can also push investors toward gold. Wars, political conflicts, trade disputes, and financial instability can make investors nervous. During uncertain periods, people often want assets that are not directly connected to a particular government or company. Gold fits this role. This does not mean gold only rises during wars. Rather, geopolitical uncertainty increases the desire for protection. And when investors around the world become more cautious at the same time, demand for gold can increase significantly. Chapter 7. Gold supply is limited. Another reason gold can rise sharply is supply. Gold cannot be produced instantly. Mining companies need years to discover deposits, develop mines, obtain permits, and begin production. Even when prices rise dramatically, global production cannot suddenly double. This creates an important relationship. If demand rises faster than supply, prices can rise. Central banks, investors, jewelry buyers, and financial institutions can all compete for the same underlying resource. That limited supply helps explain why strong demand can have a powerful effect on gold prices. Chapter 8. What does the future hold? Gold's rise is being driven by a combination of forces: economic uncertainty, central bank buying, interest rate expectations, dollar movements, inflation concerns, geopolitical tensions, strong investor demand. But gold is not guaranteed to keep rising. Higher interest rates, a stronger dollar, falling inflation, reduced geopolitical tensions, or weaker investment demand could push prices lower. So the most important lesson is this: gold is not simply rising because gold itself has changed. It is rising because people's perception of the world is changing. When confidence is strong, investors may accept more risk. When confidence falls, they often search for protection. And for thousands of years, gold has represented one thing above all: security. The gold story is therefore not just about a precious metal. It is a story about money, trust, fear, and the search for financial stability. And as long as uncertainty exists, gold will likely remain one of the world's most closely watched assets. Thank you for watching. If you found this video helpful, please like, subscribe, and share it with someone interested in gold, money, and the global economy. See you in the next video.